Everyone already made the video explaining why Bitcoin crashed below $60,000 in June. Nobody's told you what happened in the weeks after. Right now, as you're watching this, Bitcoin is trading back above $62,000. The panic sellers are gone, the people who bought their fear are not. And the gap between those two groups is about to get a lot wider. This is the part of the story nobody finished telling you. Friday, June 5th was one of the most dramatic days crypto markets had seen in years. It happened so fast that most traders barely understood what was going on while it was happening. Bitcoin, which had been trading above $80,000 only weeks before, went into a sudden, colossal freefall. Millions of phones buzzed at once as the news spread. It dipped as low as $59,100 at one point during the day, before clawing back to around $61,000 by the next morning. To the untrained eye, it looked like chaos, a market failure. It looked like the definitive proof crypto critics had been waiting years to point to. A clear sign that Bitcoin could never be a safe store of value. Here's the update nobody's giving you. As of right now, Bitcoin has climbed back above $62,000, with prices touching the $63,000 range this past week. The floor held, the panic didn't, and that single fact confirms something that was true the entire time, even when it didn't feel true. This was never a random accident. It was a controlled burn, mathematically precise, and necessary for the market to reach new heights rather than collapse for good. To understand why, picture someone who bought Bitcoin near $80,000 a few weeks earlier, feeling good about the timing. They watch it fall to 70, then 65, then 60. And by the time it touches 59,100, something in them breaks. They've checked their phone 40 times that day. They haven't slept properly in 3 nights. And on the worst possible morning, certain the dream is finally over, they sell everything, lock in the loss, and tell themselves at least the bleeding has stopped. Now picture the trading desk on the other side of that exact transaction, same asset, same week, same falling price. Someone there isn't panicking or refreshing an app every few minutes. They're calm, methodically buying every coin being thrown away, confident they'll double or triple that money within a year or two because they've seen this exact shape before. Same market, same 5 days, 2 completely different emotional experiences, and only one side understood what was actually happening underneath the price chart. Everything in this video is about closing that gap, so the next time this happens, you're not the one selling at $59,100 out of pure fear. Approximately $1.8 to $2.5 billion worth of toxic leverage was incinerated that week. Leverage is borrowed money, retail traders betting with funds that aren't theirs, and it acts like a plague on the financial system. The more it builds, the more unstable everything becomes, until the market simply cannot move forward until that leverage is wiped out. That money doesn't vanish, though. It has to go somewhere. While terrified users were smashing the sell button, the entities buying up their assets weren't amateurs. They were professionals who understood exactly what a fire sale looks like from the buying side. But this crash didn't actually start in the crypto markets. It started in Silicon Valley. Money behaves like oxygen for markets. When it flows in, assets grow stronger and more valuable. When it leaves, they weaken. And in the weeks and months building up to June, one sector was pulling in almost all the oxygen available: artificial intelligence. In just a few years, AI has worked its way into nearly every corner of modern life. And where there's that kind of power, there's enormous value, and investors were determined not to miss it. 2026 saw a wave of major AI companies going public, the masters of machine learning and the creators of the next generation of models, with valuations that were nearly unprecedented. An unstoppable wave of hype kept building as IPO after IPO hit the market. Hedge funds and venture capital firms found themselves racing against the clock to get a piece of those listings, and they needed cash fast. You might expect they'd start unloading stocks or selling off real estate to fund it. They didn't. Instead, many turned to the fastest source of liquidity available to them, cryptocurrency. Slowly, quietly, bit by bit, they drained liquidity out of Bitcoin to pour into AI IPOs. The order books thinned gradually in the background. On the surface, everything looked normal. Underneath, the foundation was being pulled out from under the market, leaving it as dry as a forest, waiting for a spark, and the algorithms knew exactly where to strike. Most people believe a healthy market should only ever move in one direction. Up, volatility gets treated like a weakness, a defect in the asset itself. The best and most successful investors see this completely differently. They understand markets move in rhythms, cycles of rises and falls, and that volatility isn't a defect. It's a requirement for any asset class to mature and reach its full potential. It has to pass through periods of structural collapse to eventually rise higher. The proof isn't in the price charts everyone stares at, and it isn't in the surface-level metrics most retail investors obsess over. It's in the deeper indicators the most sophisticated trading desks actually use to time their orders. One of the most powerful is called the MVRV Z-Score, the market value to realized value Z-Score. It sounds complicated, and in a lot of ways it is, but think of it simply as a market alarm system. When it flashes red, Bitcoin might be trading well above its fair value. When it swings to the opposite extreme, Bitcoin might be massively undervalued. Look at how that score has moved historically, and a clear pattern jumps out. During every past major Bitcoin crash, in 2015, 2018, and 2022, that score dropped into negative territory. Each time it happened, the media wrote the same headlines about crypto being too dangerous and volatile to touch. And every single time it did, Bitcoin rose by at least 300% in the cycle that followed. It's a pattern that keeps repeating. Take March 2020. The pandemic ground the global economy to a halt and sliced Bitcoin's price in half within days. The panic was real. But in the 180 days that followed, the supply held by long-term holders, the people who refused to sell no matter what, increased by 3 to 5 percentage points. That's roughly the equivalent of quietly moving America's entire gold reserve into a private vault within 6 months. This exact pattern played out again in 2021 with almost surgical precision. Bitcoin hit an all-time high near $60,000 that spring, and then a barrage of bad news, mining bans, new regulation, forced liquidations, sent its value plummeting again, cutting its price in half within just a few weeks, down into the low 30,000s. The same narrative emerged all over again. Bitcoin is over, the bull market is dead, get out while you still can. Large parts of the retail public followed that advice, sold off their holdings, and later regretted not getting out sooner. But the sharpest traders recognized something called the Wyckoff accumulation phase, a strategy named after the legendary market analyst and founder of the magazine of Wall Street, describing how the biggest players quietly accumulate before major moves higher instead of buying everything at once. During that period, an uneasy anomaly appeared. Whale wallets, the ones holding 1,000 Bitcoin or more, actually declined by around 12%, while smaller retail wallets increased as everyday investors bought the dip hoping for a quick profit. The narrative shifted to something even scarier. Big money is abandoning Bitcoin. The public bought that story too. But the whales weren't leaving. They were quietly preparing for a massive leverage wipeout. On May 19, 2021, it arrived. $8.6 billion vanished within a matter of hours, enough money to buy the Dallas Cowboys, one of the most valuable sports franchises on the planet, outright, and still have $3 billion left over. Retail accounts were liquidated down to nothing almost instantly. And that single event set up the largest wealth consolidation since the 2008 financial crisis. By the end of that year, Bitcoin had surged again. 2026 is almost a mirror image of that exact pattern. Same headlines, same fear, same emotional toll on everyday investors, but this time there's a safety net that didn't exist in 2021. A floor built by the most powerful financial institutions on Earth. In early 2024, the rules of this market were effectively rewritten when the SEC approved the first spot Bitcoin ETFs. Bridging the gap that had separated Bitcoin from the traditional financial system for more than a decade, BlackRock and Fidelity jumped in immediately. And by the end of that year, they held roughly 900,000 Bitcoin between their institutional vaults, about 4.6% of the entire circulating supply, just shy of the 1.1 million coins believed permanently lost, along with Satoshi Nakamoto, the pseudonymous creator of Bitcoin, worth roughly $80 billion today. Institutions don't trade the way retail does. They buy to secure an asset and build from there, not to flip it for a quick gain. When BlackRock takes control of a coin, it effectively leaves open circulation. During this year's panic, headlines pointed at $1.4 billion flowing out of spot ETFs as proof that institutional interest in Bitcoin was dead and buried. Against the size of these mega funds, that number is a drop in the ocean. The vast majority of institutional capital never moved at all. It's sitting exactly where it was before the panic began, because these firms understood the structural reality of the market and knew that holding the line would secure the asset supply and build an even stronger floor for the future. It's worth saying clearly, though, that it isn't one unified institutional voice anymore. Michael Saylor remains as committed to Bitcoin as ever, laying out prediction after prediction for the next decade. Meanwhile, veteran trader Peter Brandt has publicly floated rotating out of Bitcoin and into gold, based on a technical breakout he's watching in the ratio between the two. Even the smart money is arguing with itself right now, and that disagreement is worth paying attention to, not smoothing over. Bitcoin's scarcity makes all of this sharper. There will only ever be 21 million coins minted in total. No central bank can print more. No political decision can expand that supply. And it's scarcer than even that number suggests, because a huge share of those 21 million coins aren't available to buy or sell and never will be. They're sitting on lost hard drives, trapped behind forgotten passwords, or held in cold storage and untouched for years. A metric called illiquid supply measures the percentage held by wallets showing zero intention to ever sell, and it hit an all-time high of roughly 78% back in 2024. That means only about 22% of all Bitcoin ever mined is actually available on the open market at any given time. Picture trying to buy a home in a major city where 80% of the houses can never be sold under any circumstances. If a huge share of an asset's supply is essentially locked away and removed from circulation, even a relatively small increase in demand can trigger a violent vertical move upward. It's like a spring being wound tighter and tighter, just waiting to release all the energy it's been storing up. Which brings us to the most uncomfortable truth in all of this. Who actually pays for bull markets? Ask most people and they'll say retail investors. Ordinary people opening accounts and buying a little crypto every month are the ones driving prices higher, that the public has the real power here. That's a carefully engineered lie. Retail doesn't drive bull markets. It provides the exit liquidity that makes them possible, and to understand why, you have to understand how institutional order books actually work. A multi-billion-dollar hedge fund or ETF issuer can't just log into an exchange and buy tens of thousands of coins at once. That would have a massive, violent impact on the price and work against their own interests. Instead, these mega funds prefer to expand their position without moving the market right away, which means they need to trigger a wave of sell orders to match their buying. In plain terms, they need thousands of individual investors to panic and sell at the exact same time and price point. That's not random chance. The same algorithms used by market makers can identify exactly where large clusters of stop-loss orders are sitting, the price levels where retail investors have already decided they'll sell to cut their losses. As the market approaches those levels, even a relatively small wave of selling can nudge price further down, closer to that stop-loss zone. Once the first orders trigger, a chain reaction begins, a wave of additional automatic sell orders follows, executing without anyone even having a moment to reconsider. The price drops further, hitting more and more of those limits along the way. Within minutes, the damage is done, and the average investor watching it all unfold gets scared and starts dumping their own coins right as the value has already fallen about as far as it's going to fall. That's exactly when Wall Street rushes in, snapping up everything that just flooded the open market. Here's the part that should make you feel better, not worse. Despite everything that just happened, the macro models used by serious analysts are still largely pointing higher, and their optimism hasn't really changed. Some forecasts have Bitcoin reaching somewhere between $150,000 and $180,000 by the fourth quarter of this year, but that's not unanimous, and pretending otherwise would be dishonest with you. Citi actually just cut its own 12-month Bitcoin target down to $82,000, citing weaker ETF demand than expected. And prediction markets, where people put real money behind their opinions instead of just their mouths, currently priced in only about a 4 to 5% chance of Bitcoin hitting $150,000 before next January, while assigning a much higher probability to a further drop toward 55,000 at some point later this year. Different models point in different directions, and they keep changing as conditions change. In moments like this, big price moves are usually tied to shifts in liquidity, leverage, and overall positioning rather than any single clean cause, and capital tends to move around the system in ways that aren't always visible in real time. The honest picture right now is a genuinely split one. Real optimism from serious people, sitting right alongside real caution from other serious people, with the forecasts shifting as new information comes in week to week. That tension is exactly the point. The story was never about one crash or one rally. It's about cycles, how liquidity enters a market, how it leaves, and how the entire structure reshapes itself every time that happens. Price doesn't move in one direction forever. It moves through phases, and every phase becomes the foundation the next one gets built on. Someone sold at $59,100 in a panic in early June. Someone else bought that exact same coin without blinking. Only one of them understood which phase they were actually standing in. So here's the real question worth sitting with. When the next one of these moments comes, and it will, which side of that trade do you want to be on? Tell me in the comments whether you held or sold back in June. I actually want to know. If this helped you see the last month differently, subscribe so you don't miss the next one. And if you know someone who panic sold in June and is still kicking themselves over it, send them this. It might change how they see the next crash before it even happens.